President Donald Trump's proposal to introduce a federally backed 50-year fixed-rate mortgage is a direct response to the deepening crisis of housing affordability in the United States. The concept is straightforward. By extending the repayment period of a home loan far beyond the conventional 30 years, the monthly principal and interest payments would be significantly reduced. This reduction aims to lower the barrier to entry for first-time buyers, low to moderate income families, and others struggling to meet the qualifying debt-to-income ratios required for standard mortgages amidst high interest rates and soaring home prices. Advocates, including figures like Federal Housing Finance Agency, FHFA, Director Bill Pulte, frame the 50-year mortgage as a complete game changer that provides a crucial entry point into homeownership. They argue that for individuals currently forced to rent, a 50-year mortgage, even with its higher long-term cost, is a superior alternative that allows them to start building wealth and benefit from home appreciation sooner. Furthermore, the argument suggests that borrowers can always refinance to a shorter term or accelerate payments once their financial stability improves, thus avoiding the full 50-year commitment. However, the analysis reveals a crucial trade-off. While the monthly payment offers short-term relief, the total cost of the home explodes. A 50-year term can result in total interest paid that is nearly double or even triple the amount of the original purchase price, and hundreds of thousands of dollars more than a 30-year mortgage on the same property. This dramatic increase in lifetime interest is the primary critique, leading many to label the proposal as a generational debt trap that primarily enriches banks and lenders. Reasons and consequences. Reasons for the proposal. The push for a 50-year mortgage is driven by two main economic realities. 1. High barrier to entry. Steep home prices combined with sustained high interest rates, above 6% in recent periods, have made the standard 30-year mortgage payment unaffordable for a large segment of the population. Extending the term is a mathematical lever to lower the required monthly expense, enabling more buyers to qualify under stringent underwriting standards. 2. Addressing political pressure. Housing affordability is a potent political issue. The proposal is positioned as a tangible action item to address public frustration, offering a quick-fix mechanism to alleviate the burden of monthly payments without requiring massive federal spending on subsidized construction or complex local zoning reforms. Consequences. The consequences of widely implementing a 50-year mortgage could be profound and largely negative, according to most independent financial experts. 3. Exaggerated lifetime debt. The most severe consequence is the massive increase in total interest paid. Borrowers would be locked into debt for an extended period, often well into their retirement years, with some calculations showing they might pay 225% of the original home price in interest alone. 4. Slower equity accumulation. Due to the amortization schedule, early payments on a 50-year loan are overwhelmingly allocated to interest, not principal. This results in painfully slow equity buildup. For example, it might take nearly 40 years to achieve 50% equity, compared to just over 20 years for a 30-year loan. Slow equity leaves homeowners vulnerable to market downturns and makes it difficult to trade up or use home equity for other financial needs. 5. Increased home price inflation. By artificially increasing the buying power of consumers without addressing the root cause, a severe housing supply shortage, the 50-year mortgage is likely to stimulate demand. This increased demand, chasing a limited supply of homes, would drive prices higher, ultimately making housing even less affordable for everyone. 6. Lender risk and higher rates. Longer loan terms introduce greater uncertainty regarding a borrower's financial stability and lifespan, potentially increasing the risk of default for lenders. To compensate, financial institutions would likely impose a higher interest rate on 50-year mortgages compared to 30-year loans, further eroding the modest monthly payment savings. Prediction and solutions. Prediction. If the 50-year mortgage proposal were implemented and adopted widely, the immediate effect would be a modest, temporary easing of monthly payment pressure for certain buyers, leading to a surge in demand. However, the long-term prediction is one of structural market damage. House prices would likely continue to appreciate rapidly due to the demand stimulus, and a generation of homeowners would find themselves with significantly less equity and higher lifetime costs than their predecessors, potentially struggling to pay off their homes before they die. The political optics of solving the affordability crisis would clash with the economic reality of inflated asset prices and suppressed generational wealth creation. Solutions to housing affordability. True solutions to housing affordability must focus on the supply side of the equation rather than debt engineering. 7. Zoning and regulatory reform. The single most effective step is to roll back restrictive local zoning ordinances, e.g., limits on multifamily housing, minimum lot sizes that artificially constrain housing density and construction. Easing building codes and streamlining permitting processes at the municipal level would lower construction costs and increase supply. 8. Subsidizing starter home construction. Federal and state incentives should be redirected to support the construction of affordable starter homes and missing middle housing, duplexes, townhomes, rather than luxury units. 9. Financial education and alternative products. Promote existing alternatives like 40-year mortgages, currently available under specific circumstances, and increase financial literacy regarding amortization. For buyers requiring assistance, down payment assistance programs are a more fiscally sound way to reduce the financial burden without ballooning the lifetime interest payment. 10. Portable mortgages. Another proposal gaining traction is the portable mortgage, allowing homeowners to transfer their lower locked-in interest rate when they move. This would unfreeze the market by incentivizing current homeowners, many with low rates, to sell, dramatically increasing existing housing inventory without stimulating unmanaged demand.